Good evening. This is Renan Guillou with Olympic Golden Retirements and Wealth Watch Advisors. I created this short video that I want to share with you tonight because I sent out some emails over the past 3 months with this white paper, with a link to this white paper, and not many people have read it. So I took the liberty of going through this and highlighting sections so we can read together. But before we do, I want to bring a couple headlines to your attention. So today, the Dow is down 1.9% after having been down, I think it's at one point it was 4%, so it recovered some. All right, this is already after some significant declines from our highs and certainly from where we are year to date. We are down on the Dow. Now, earlier this year, JP Morgan co-president sees possible 40% correction in equity markets. All right, you can read that article. Morgan Stanley said stock slide was appetizer for real deal on February 19th. And again here, from a diversified portfolio may not help investors much this year. I think this is also JP Morgan, again, research. But you can read that on your own. So what is the solution? Where do you go? And that's what I want to discuss here by reading over the white paper. Obviously, there are different options, right? I mean, annuities are one way to help protect some of your savings and generate income, but we all know we can't be all in annuities and have all our assets in annuities. We have to have some money in the market because sitting on cash means that we're losing 2 to 3% to inflation each year. So what is the solution? Well, this white paper covers the artificial intelligence investment strategy called the Solomon API that we use at Wealth Watch Advisors. I'll read this one here. The challenges of today's global equity markets are subjugating the success of conventional investment strategies and forcing investors to chase returns. This white paper examines the current global economic environment and the effects of globalization, unprecedented debt, and rising interest rates on investments. It also investigates the failures of buy and hold and active management investment strategies and explores the aptitude of an artificial intelligence investment strategy and its viability in the new global equities market. Now, basically two big challenges here, the new global economic environment and the shortcomings of existing investment strategies. So we have navigating a whole new world, right? So U.S. and global debts are reaching unprecedented highs. Central banks are keeping interest rates low and instilling a false sense of economic confidence. You have high frequency trading and just global events that are increasing market volatility. Globalization is creating portfolio diversification challenges, right? Because the correlation and interconnectivity of our economies across the globe are creating these portfolio diversification challenges, right? You've heard that when the U.S. sneezes, everyone else gets a cold. Well, this is even more true today. So there's collectively, these new economic factors have set the stage for diminishing returns, future volatility, and market dislocation. So exploring dated tactics. So you have buy and hold, which is asset allocation, and active management, or professionally managed or do-it-yourself portfolios. Now, buy and hold assumes that the investor and investment professionals are emotionally strong enough to ride out market volatility. According to Dalbar research here, buy and hold does not work for average investors because we are loss averse and we simply don't have the emotional strength to withstand market volatility. In contrast, active management is failing investors for various reasons, ranging from economic influencers to the inability to analyze complete market data in real time. Okay? I mean, there's lots to read here, but I'm just trying to get the headlines and the main things out here. So today's options: chase returns or employ artificial intelligence. So these multifaceted challenges have created an investment environment of uncertainty, diminishing returns, and the willingness to chase returns while assuming significantly greater risk. Investors need to be reminded that assuming more risk does not always equate to higher returns, and in fact, could result in financial hardship. So, in response to the quest for sustainable solutions, an innovative, viable strategy has emerged: artificial intelligence investment strategy. It is designed to help navigate the complexities of the new global equities market by providing the investors with overall risk management perspective beyond their portfolio makeup. So this is what it consists of. And of course, you can pause this anytime you want. Problem. How do I actually get a true return on my investment that justifies the risk? So this is just going into depth of what we just covered, right? So challenge 1, new global environment. Debt, global debt. Okay. Nice pie chart of our global debt. Market sensitivity from high frequency trading and world events. Challenge number 2, the shortcomings of existing investment strategies, right? So you have the buy and hold. For this to work, you have to have emotionally strong enough to, you have to be emotionally strong enough to withstand market volatility. And condition number 2, ideal market entry and exit timing. How does modern portfolio theory asset allocation fare in the new global economic environment? Going on here, and again, you can download this anytime or pause the video here. This shows, that basically the true cost of a loss, the whole concept of buy and hold, wait for it to come back. Well, of course, if you lose 10%, you need 11% to make up those losses. If you lose 20%, you now need 25% to make up those losses. And when you lose 50%, you now need 100% to make up those losses. So aside from, the time, which you can't make up the time lost while recouping those losses, nor can you avoid accentuating those losses if you have to use this portfolio to take money out to, for the income you need to pay for your monthly expenses. So active management utilizes an investment professional or team of professionals to actively manage a portfolio. Okay. Overall, active management has underperformed buy and hold strategies. And that's what this whole section is about. So investors are unable to commit to long-term plans in active management, right? So Dalbar also determined that investors are not remaining invested in their funds for the long haul, and that their movement into and out of such funds coincides with market fluctuations, right? There's studies that show that more money poured into the market at the height of the market before 2008, and more money poured out of it as the market was crashing and was actually, hitting its lows. Active management allows for emotional investment decision making, right? Humans are irrational, so that irrationality leads to buying and selling at the wrong time, which leads to underperformance. Prospect theory, this is a little interesting. Prospect theory, also known as loss aversion theory, suggests that people express a different degree of emotion towards gains than towards losses. Individuals are more stressed by prospective losses than they are happy from equal gains. A loss always appears larger than a gain of equal size. Therefore, when investors are faced with the challenge of bearing the pain and discomfort associated with market volatility, they tend to sell low or buy high, a counterintuitive action to a successful investment strategy. Investor behaviors. All right. Investors are subject to the true cost of loss with active management. It costs an investor more to break even than it does to prevent loss. And even if the investor is able to break even, he or she can never make up the time that has been lost in doing so. The solution, artificial intelligence investment strategy, is intelligence exhibited by an algorithmic trading system. AIIS perceives its environment and takes actions to maximize its chance of success in meeting the investor's goals. So it can assimilate real-time performance, real-time information, and work to recognize potential market transitions with the goal of helping investors avoid major market corrections. Buy and hold. So unlike buy and hold, where the investor is vulnerable to making investment decisions based on emotions, AIIS utilizes a non-emotional, algorithm-based system that works to capture potential opportunities. So active management, some active managements do have, their own algorithms, but historically their algorithms fall short as they are unable to successfully process data for optimal investment outcomes. It's one thing to have the data; it's another thing to be able to process it and generate some intelligent strategies and responses to that data. Investing in the market can be emotionally challenging. AIIS's goal is to help keep investors committed to their overall investment strategy. So Solomon API, which is what we use, our investment strategy, Advanced Portfolio Intellect, has been at the forefront of AIIS technology development for more than 10 years. Its sophisticated AIIS is designed to help investors avoid major market corrections. So, artificial intelligence algorithm drive, the primary system acquires information 24 hours per day in response to actual real-time market movements. Okay, the goal is to detect bull and bear market shifts and capitalize on those. In addition to the AIIS strategy, the Solomon API, we've also partnered with AssetLock. Through AssetLock, the leading investment portfolio monitoring and communication tool, AIIS is able to monitor the investor's accounts daily. Okay, so it offers more transparency. So this is also the brochure that I have sent out a few times by email. So basically, step one, right? Select a cost-effective portfolio from the 20 or so Solomon API portfolios that we have, and that will adhere to your risk tolerance and work to meet your long-term goals and investment goals. Enhance your portfolio with Solomon API, right? And oversee your portfolio with AssetLock. So the three combined, and do I have, so AssetLock is a third-party software, so you have an account there too, and it basically monitors your account and it tracks, where the highs of your account, and for different portfolios, we have a different AssetLock value associated with that. So let's say one portfolio has a 10% AssetLock. So whenever AssetLock will track the portfolio, and when it reaches a new high, it basically fixes a 10% AssetLock value, at which point we can set it to trigger an automatic stop loss. So all your portfolios would be moved to cash if it went down to 10% or past. Or it can just be served as a notification system. But this is how we use, what we use to help protect our clients' portfolios and capitalize on gains and market opportunities. So I hope this little overview of the white paper has been useful, since, again, I know most people have not and would not actually read it. The other thing here I want to bring to your attention is these are two tear sheets. So a normal 60-40 portfolio, which means 60% stocks, 40% bonds. In 2008, in 2002, in 2008, there were portfolios that were down 30, 40, 50%. Okay? And these were supposedly balanced portfolios. What you see here in the blue, so that's the red. Okay? The blue is the actual drawdowns, meaning the loss of that portfolio, the drawdown, during that same time frame. So here we're looking at 10%, and in 2011, yes, it reached, I think, 13% or something of the sort. What does that mean? It means that this is Solomon API in action. This is how we protect our clients' portfolios from these massive drawdowns. So that if you are pulling money out from this portfolio, right, and you haven't diversified and used other assets to generate income, which I do suggest, this at least would really minimize, how much you'd have to take out of your portfolio when it's down. And as you can see, just a buy and hold, if you had invested in this portfolio as a long-term strategy, right, you come out significantly ahead of just a buy and hold through the ups and downs of the market, because, again, we're overstepping and sidestepping the big drawdowns in the market, the big downturns in the market. So that's one example, and this is just another example of a 60-40 that we have as well. So I hope that's useful. If you need any of this information emailed to you, or you want to have a conversation, please reach out. Now is the time to start being protective, defensive, and look at really coming up with an overall retirement income plan. Lastly, I apologize. If you want to actually see how to put together a comprehensive retirement income strategy, go to Retirement Income Revolution, put in your email, and there you can watch a 20-minute video, 20-minute video, where I explain and show you how to put together a retirement plan where you have certain assets designated for income and other assets designated for growth. So if you did have that and you were in a portfolio like this one, for example, well, if this portion of your portfolio is what we've allocated for growth, even if it was down 10%, it's not a concern to you because you've got your income coming from another pocket, another leg in this plan. So you're only taking money out of here when it's up, when it's positive, and not during these drawdowns. Okay. Have a great evening.